to this session on the 2008 financial crisis, 10 years after the fact, which we've been discussing quite a bit here for the last few weeks, as everybody else in the country has been doing it. And we thought this would be a great opportunity to tell you a little bit about our conclusions and to get your feedback and questions and comments and criticism. So much. We're going to go for about an hour here on the stage and then break up and go to next door to have pizza or just talk more generally. So you're welcome to do that as well. So I'm John Taylor, and we're going to hear from George Shultz, Neil Ferguson, Karen Hawksby, Darrell Duffie, and John Cochrane. We're each going to make a few short remarks about causes, panic, recession, and some lessons. And I'm going to quickly start off because my responsibility was more on the causes side. And so I focused a lot in my research and the presentation in the last, our discussions on the role that monetary policy had in causing and bringing about the financial crisis. I examined what happened in 2003, 4, and 5 in particular, when by many calculations, the interest rates of the Fed were held very low by historical comparisons. And studied that carefully over the years and saw that that led to excesses, sometimes called searching for yield because that rate was so low, maybe excess risk-taking to get a higher rate, excesses that spread to the housing market. And one of our colleagues, Monica Piazzesi, explored that in great detail about the excesses in the housing market, and it brought a housing boom on like you've never seen before, and an ultimate collapse. And as that was happening, loans were being issued, very favorable terms, but turned out to be very risky themselves. So in a way, that was the beginning, and it also spread very quickly, I think for obvious reasons. It also spread internationally. You can trace the impacts of the Fed on other central banks around the world, even at that time in Europe, so some of their problems were related to that as well. And what Monica Piazzesi did in her research, her presentations, is trace those low rates, that particular period, to the excesses in the housing market, and can trace particular sectors and sees that as a real problem. Of course, that explanation is not stressed by the Fed very much. I've had debates about that with Alan Greenspan and Ben Bernanke and others, although I think to some extent the current Fed is moving in a different direction. One more thing I'd say of my contribution to this was what happened on fiscal policy as the recession got going. And we've studied this a lot, and it seems that the specific stimulus packages, first passed in 2008 when Bush was president, and later with Obama, really didn't do much good. The money just went into people's pockets. It really wasn't much effect on the economy. And we have a lot of data on that to show you. There's debate about it. And one thing I'll just conclude with, I've noted in the 10 years, which we've all been working on this at least since then, is that the inevitability of time shapes people's views. Maybe originally it was financial reports or early researchers, then you have people writing stories who were in charge at the time, they have a different view. And so now we're just beginning to sort of sift through all this and hopefully get to an explanation or several explanations which are helpful for creating lessons or learning lessons for the future. So I'll stop there and turn it over to George Shultz, who has had so much experience in the cabinet and in research and in universities. Anxious to hear what you say.
I think John has given part of the reason why we had the crisis. But in a sense, a deep reason is the, I think, pretty well justified notion in all societies that home ownership is a good thing. So in this period, there was an effort to encourage it very strongly by Freddie Mae and Freddie Mac, and they encouraged low loans to spread home ownership. These loans were very risky because if there was any dip in the house prices, the people didn't have the ability to pay back the loans. So they started to spread very widely. And then the big banks got in on the act. I might say, as you said, that not only Freddie and Freddie, but the Federal Reserve kept interest rates very low, so it encouraged this process. But the big banks got in this by securitizing these loans, thinking mortgages are safe. But then it turned out they weren't. So they were now holding large amounts of debt that wasn't good. And this was a big problem. Then what happened? Then it became clear, first of all, in the case of a bank called Bear Stearns, that this bank couldn't handle its situation. And so through an odd process, Bear Stearns was bailed out in the sense that the bad assets were taken over by the Fed, and J.P. Morgan acquired the balance of it. And then a bigger company called Lehman Brothers also was under pressure, and there was a big effort to bail out Lehman Brothers, but in the last minute, regulatory glitches prevented that from happening, and so Lehman Brothers failed almost sort of suddenly. A sudden bankruptcy like that is very different from an orderly run bankruptcy. So that was very disruptive. And so a sense of panic emerged. And the Federal Reserve Chairman and the Secretary of Treasury went to the Congress and they said, the sky is falling. We have to have a huge amount of money to deal with these bad loans. And they acquired the money, although everybody knew there was no way to purchase the bad loans because no one knew how to put a price on them. The nominal price was obviously not the real price, so what should be the price? They didn't know. So they wound up with the money going to the big banks that were thought to be in an uneasy position. And other bailouts took place. So I think the result of all this is you violate three fundamental principles that need to be kept in mind. One is accountability. It wound up that there was not accountability. Number two is a sense of competence. Are the people competent running things? That was violated. Number three, trust. You have to have trust that the people doing things know what they're doing, and that was violated. So I think the net of all this was a very bad episode, and we still pay the price for it because the bailout mentality is in people's minds, and it encourages people to take risks that they otherwise wouldn't take. So we've got to get back to a day when the bailouts are not in the picture, where competence is rewarded and trust returns. My own thinking is affected by a personal experience I had back in 1970 when I became the first director of the Office of Management and Budget. I found that a large financial company called the Penn Central had mismanaged its affairs and was about to go bankrupt. And the head of the Federal Reserve, a giant of a man named Arthur Burns, thought that if that happened, it would ruin the financial system. So I'm sitting there arguing. I didn't think so. So I'm arguing with Arthur, having me saying, what am I doing arguing with Arthur Burns about the financial system? He knows everything. But anyway, along comes a man named Bryce Harlow, he was the savviest political counselor in Washington. And he said, Mr. President, in its infinite wisdom, the Penn Central has just hired your old law firm to represent them in this matter. Under these circumstances, you can't touch this with a 10-foot pole. So there was no bailout. And what happened? The financial system was strengthened because everybody had to look at their whole card and say, hey, we better get ready, we're not going to get bailed out. But Arthur did the thing that was very important and which the Fed can do. Namely, he flooded the market with liquidity. So there was no liquidity crisis. He saw to it that there wasn't. And the result of letting people fail, keeping them accountable, made a big difference.
Thank you, George. Neil.
Well, as the non-economist on the stage, I'm going to begin with the Queen's question. Her Majesty the Queen in December 2008 visited the London School of Economics and asked, why did no one see it coming? And I was very offended by that question because I had seen it coming. I'd spent most of 2006 writing op-eds about subprime mortgages. I'd spent some of 2007 thinking about what a liquidity crisis might look like. In January 2007, I wrote, it's perfectly possible to imagine a liquidity crisis too big for the monetary authorities to handle alone. Governments would need to step in. Federal bailouts for the likes of Goldman Sachs may seem unimaginable to us now, but financial history reminds us that such events do happen, and liquidity can ebb much more quickly than it previously flowed. It was a long time before Lehman Brothers went bankrupt. And I published The Ascent of Money several months before the Queen asked that question, as you can't write a book overnight, and the whole point of the book was to explain a major financial crisis to the lay reader. I think I can claim to have done a not bad job as a financial historian of seeing it coming. The Ascent of Money offers 6 explanations for the biggest financial crisis to hit the world since 1929. One that I think we would all agree on, the undercapitalization of banks, and we'll hear more about that, so I won't dwell on it. Another point that hasn't been mentioned was the way that structured financial products like collateralized debt obligations proliferated, and rating agencies insisted that they were AAA rated when they really were nothing of the kind, since they were based in part on subprime mortgages in many cases. Monetary policy, here I'm channeling John Taylor, had been loose for most of 2002 to 2004 in a way that really wasn't defensible. There was funny stuff, as George Shultz has mentioned, going on in the US real estate market. The derivatives market, 0.5, had created a whole bunch of rather opaque contingent liabilities that hadn't been there before. And then finally, I think you have to include in the explanation China and what we used to call global imbalances, in particular the great flow of Chinese capital into the US economy in the form of a kind of vendor finance. So my own view is that you can't explain the financial crisis without reference to those 6 things, though you can certainly argue about their order of importance, and I didn't put undercapitalized banks first by accident. The catalyst was the Lehman Brothers bankruptcy, but the crisis had already begun. It was obvious in early 2007 that there was a problem if you were paying attention, because the resetting of adjustable rate mortgages fed straight into a series of minor financial crises. So I think it's sometimes the case that people exaggerate the importance of the Lehman bankruptcy, which can't be seen separately from the other institutional crises of 2008. What's fascinating to me, and I focused in my presentation in this series on the panic, was the way that the Fed tried very hard to recover from the Lehman bankruptcy, but failed because a chain reaction had begun that it was actually really impossible to stop. And that chain reaction included, for example, the freezing of the commercial paper market, the blowing up of the credit default swap market, and then, of course, the revelation that, in fact, the fiscal authority might not step in when the first TARP vote on September the 29th went against the TARP bill. Let me add a couple more points, and then I'm going to hand over to Caroline Hawksby. The second big question about the crisis is why it didn't become a Great Depression. Paul Krugman and others kept insisting that it was going to be a Great Depression, and it looked like it was turning into one for certainly the first 6 months after September 2008. If you were following Barry Eichengreen's work with Kevin O'Rourke, who were comparing the events of 2007-8 with the events of 1929-30, it was absolutely terrifying. But it wasn't a depression. And I think there are three reasons for that. One, and we can debate this in a moment, was monetary policy. The second, to a lesser extent, was fiscal policy. By these policies, I'm referring to the United States. But there was a third reason why the world did not go into depression that has received much less attention, and that was China's stimulus, which was the successful stimulus, much, much more successful than the US stimulus, and had massive spillover effects, bailing out any economy in the world that was heavily reliant on commodity exports, for example. It was a global financial crisis. I like the fact that Australians call it the JFC. It very quickly, as John mentioned, became global. And the reason it didn't become a depression, I think, was also global. There's a third question, which is why was the recovery not faster? That's a very different question from why wasn't there a Great Depression. But Caroline can answer that third question much better than me.
Thank you. So I'm Caroline Hawksby. I'm a labor and public economist. When we think back to the Great Depression, it started with a financial crisis as well in 1929. And a lot of labor economists believe that one of the reasons it lasted so long was that it had follow-on effects in the labor market, which failed to readjust and reallocate people to new jobs. People adjust much more slowly than does the stock market or other capital markets. And it's often difficult for them to give up one job in which they felt they were productive, maybe move to a different place, in fact, and move into a new job where they're going to be more productive. People just don't like to move that much. They don't like to adjust that much. The Great Recession is in many ways as great as it was, because although it started with a financial crisis that is not that dissimilar to financial crises we have had otherwise, labor markets really did not adjust quickly as a result of the financial crisis, leading to a much longer recovery, a much slower recovery, and in many ways, a recovery that has never completely occurred. Despite the fact that we have low unemployment rates, I'm going to tell you about a few statistics that suggest that the labor market is still not fully adjusted. So one of the things that happens at the beginning of a financial crisis or of a recession is that employers who have had workers who are not as productive in their jobs as their wages would indicate often use that as an opportunity to kind of clean house, get some of their workers off their rolls, decide not to hire new workers, change the work arrangements. So that is very important for workers who are let go at that point in time to readjust and find themselves new jobs. How do we know whether that readjustment has occurred? Well, there are several indicators that we can look at, and all of them look quite bad from the point of view of the Great Recession. The first one is the labor force participation rate. The labor force participation rate is someone saying to the government when asked, yes, I am trying to find a job, I'm interested in having a job. That means you're participating in the labor force. The labor force participation rate fell very sharply during the Great Recession, immediately following the financial crisis, and it has never really recovered. It fell, it has recovered just a little bit, but it is still much lower than it ever has been in recent years in the United States. So that's a suggestion that there are a lot of people out there who do not feel that it is worthwhile to look for a job or participate in the labor market. And disturbingly, the labor force participation rate has not only fallen for people who are very close to retirement. That's kind of a normal thing during recessions, that if I'm 62, say, or I'm 60 and I become unemployed during a recession, I might think it's not worthwhile looking for a job again because I'm pretty close to retirement. The labor force participation rate has also fallen for really prime age workers, like 35-year-olds, and that's a significant problem. In addition, even if you look at people who are participating in the labor market, you will see that they're saying they're looking for a job, that not only are they less likely to have a job, but conditional on having a job, they're working fewer hours a year. And that also fell very sharply during the Great Recession and really has not come back. Again, that's another indication that people have not found their most productive use in the labor market, and it's a great drag on GDP growth, which is essentially a function of how many work hours there are in the United States times what the productivity of each work hour is. So if you have work hours fall in total, it's very difficult to have high GDP growth. Another indication that the labor market has not reallocated well, and I think perhaps the single most disturbing one, is that some of the flow out of people working has been into the disability program. And again, this is disturbingly among prime age people, where it's really not believable that the cause of the increase in disability is that suddenly lots and lots of 35-year-olds and 40-year-olds have become much more disabled than they were before. The disability program has been somewhat on a long-term trajectory of growth, but it grew quite rapidly during the Great Recession, and it really has maintained that higher level. The reason I say this is very disturbing is that for all intents and purposes, when someone becomes classified as disabled in the United States, they usually stay that way for the rest of their lifetimes and go straight into retirement from the disability program. So even small changes in the disability rate among prime age people, say a 35-year-old, that will mean 30 years of being in the disability program and not working. And there's quite a bit of evidence that actually people who are disabled parents are more likely to have children who don't have very much experience with the labor market and may themselves have more difficulty holding a job. So even small changes in that program can be quite disturbing. Another indication that the labor market didn't adjust very well is that although the federal government did try to help a lot of people go back to school during the Great Recession, that definitely happens during every recession, is that people go back to school. We did not see that all of this going back to school seems to have produced people moving into sectors that were higher employment growth sectors, or moving into jobs where they were likely to find higher wages, or moving into jobs that were more likely to be in the tech sector or in the information sector or other sectors that were relatively fast growing. In fact, what we saw was that many people did go back to school. Many of them went to for-profit online schools. The modal person who went back to one of these schools was actually around 35, 36 years old. So we're not talking about 18 to 20-year-olds going back to school. We're talking about people in their mid-30s and early 40s going back to school. And the evidence suggests that, one, most of them left without ever getting a degree or certificate of any type, a credential of any type, but also that their earnings really did not grow after having gone to these schools, and they were not successfully moving into jobs in more high-growth sectors. So lots of going back to school financed by the federal government, but it looks like it was more of a holding tank for people who were underemployed than it was something about trying to reallocate in the labor market. And the final indication that the labor market has really not adjusted very well is that although people are not always fully aware of it, not every labor market in the United States suffered very much from the Great Depression. There were some metropolitan areas that had unemployment rates that remained very low throughout the entire recession. There were other labor markets that had unemployment rates that were as high as about 15%. Well, you really want people to leave the places with the unemployment rates of 15% and go to the places with the unemployment rates of 3 or 4%. We really didn't see a lot of that migration during the Great Recession. And that's disturbing because that's part of the way in which people move themselves from less productive activities to more productive activities, which is what we would like to see. I guess I just want to say one thing about this, and that is I think I'm less optimistic than most of my fellow economists here, because I am concentrated very much on the labor market, where I see a lot of indications that the Great Recession, to some extent, still continues. I think things have improved. We all know that the unemployment rate is low, but part of the reason it's low is that a lot of people have dropped out of the labor market. And I think we ought to think about the consequences of that for the long term, having such a large share of Americans not participating.
Thank you. Darrell.
Thanks, Carolyn. My name's Darrell Duffie. I'm a financial economist. And I first want to say I'm just amazed to see so many of you here on a Friday afternoon, the last day of classes of the quarter, last Stanford day of the year. And I guess that means that the financial crisis must have been a pretty formative event that affected a lot of lives, and that there's still curiosity to try to understand what happened, what went wrong. And I want to bring your attention after we've talked about monetary economics, and we've talked about housing markets and labor markets. I want to refocus attention back to the core of the financial system where the giant banks are, the famous, as Neil mentioned, Lehman, and that big shock. How did we get to that point where those giant banks were in such bad shape, and when they toppled over, caused such damage that we're all still interested 10 years later? And while there are many, many lessons to be learned, the one I want to focus on is too big to fail. I'm sure you've all heard about that. Before the financial crisis, and I've reviewed a lot of primary source documents, letters, internal investigations, congressional testimony, and so on. And to the best that I can figure, the regulators in this country assumed that these large banks would look after themselves. That was called market discipline. The idea being that if you didn't have enough capital, then no one would lend you money. And if they wouldn't lend you money, wouldn't matter if you wanted to get in a big, risky balance sheet, they wouldn't let you. Well, that didn't work. And the reason was too big to fail. These banks, it was correctly assumed at the time that if one of these banks were to fail, that it would cause a crater on the economy. And as Neil has already described, the impact, not just of Lehman, but of the threat that these big, giant banks would collapse and crater the economy. And creditors before the financial crisis said to themselves that they'd never let that happen. The government wouldn't let it happen. The government, if necessary, will bail out these banks because surely they wouldn't cause a crater on the economy. And that was proven to be false. But while that presumption existed, creditors were happy to lend money to these giant banks at rock bottom interest rates, very cheap sources of funding. They were able to borrow money almost at risk-free interest rates, as though they were they had no risk at all, because the creditors believed that if the banks would get into trouble, the government would bail them out. Well, that cheap sources of funding, the ability to borrow money at almost no higher interest rates than the Treasury, let's say, that was like jet fuel to their business plans. They now had the ability to grow enormous balance sheets with very cheap sources of funding, and they did. Assets in the largest 9 US banks tripled in size between the turn of this century and the doorstep of the financial crisis. Tripled. Since then, things have changed. The idea that the government will bail out a large bank has been disposed of, or at least in the minds of the creditors. They no longer give credit to the idea that they will get bailed out if the bank gets in trouble. So now, when sophisticated institutional lenders consider the interest rate at which they're willing to lend money to a giant bank, they know, or at least they presume, that if the bank gets into trouble, they'll be forced to take a loss. And because of that, they're charging much higher interest rates, and because of that, the banks are not growing their balance sheets by leaps and bounds every year. Pretty much flat since the financial crisis. There's not a big boost of leverage or asset growth in the banking sector. One of the contributing reasons to that return or partial return to market discipline is legislation in the Dodd-Frank Act that, at least in theory, gives the government the ability to force the creditors to take those losses without necessarily causing a crater on the economy. By just telling the creditors, sorry, you no longer have any debt claims on this bank, we'll give you some equity instead. The same idea, thankfully, is wending its way through legislation to change the bankruptcy code for big banks. John Taylor and our former law school colleague, Ken Scott, led a group of economists and private sector legal experts which designed a new chapter of the bankruptcy code, which did just that. It essentially forced the large creditors to take losses rather than the government. And the presumption of too big to fail, while it's not gone away entirely, has been pushed down. The banks are much better capitalized, and even so, their costs of borrowing relative to risk-free borrowing rates have gone way up. How could that possibly be reconciled by anything else than the decline of too big to fail, the decline of the view that the government will always step in and save the creditors? That's a very important lesson. As I said, there are many more, but in the interest of time, I'm going to pass the baton to my colleague, John Cochrane.
Thanks. I'll start with just, in some way, a little introduction. This is the capstone of several sessions we've had, organized mostly by John Taylor, to think about, on the 10-year anniversary, the lessons of the financial crisis and the subsequent Great Recession. And we've had a great series of discussions. You can find slides and other materials on the Hoover website somewhere. You have to be fairly good at sleuthing websites, but under events and Hoover website, I think you can find us. And there you'll see lots more than, each of us got to talk for like an hour over the last couple of weeks, and now we're down to 5 minutes, which for academics is just torture. And the kinds of things we've talked about chronologically are what are the things in the lead up, housing, China, Fed policy, and so forth, that set the system up to be fragile. What were the events of the panic itself? What was the roles of government policy, of some perhaps unwise speeches made by our leaders, and so forth what were the mechanics of the panic? Why was there such a recession? You may say it's obvious, but as a matter of economics, it's not so obvious. Why banks having a little bit of trouble? The banks all stayed in operation, but why did financial trouble at banks lead to people in Nebraska losing their jobs? Why did that recession not turn into a Great Depression, as Neil brought out? My view on this is largely because the Fed did not screw up, which it did in the Great Depression, and they learned their lessons and didn't repeat the same mistakes, which is a good thing. Wisdom comes slowly in public policy. Why then was the recession so unbelievably long-lasting? And here there's kind of a debate between supply and demand, if you will, endless secular stagnation versus the kind of sand in the gears that stops the economy from healing. Caroline showed you some of what I agree with as well, the sand in the gears version of there's a lot of problems with well-intentioned government policies that give people incentives that keep them from working, getting better jobs, moving, and so forth. And then, which I'll close with after my second set of comments, where's the next crisis coming from? Are things better now? Have we learned all our lessons? Sadly, no. The one thing I'd like to highlight from my own thoughts on this is what is the central lesson of the crisis? And for that end, think what was different about this in 1999. So when the tech boom turned into a bust, the nation lost about the same amount of value as was lost in subprime mortgages up until the Lehman crisis. So the size of the shock was about the same. Yet in 2000, when the stock market crashed, we had a little bit of a recession, and a lot of people who were here and thought that their startup was worth $100 billion found out that no, they're going to have to work like the rest of us for a while. But it was, by and large, a minor event. Contrast that to 2008, where we had similar underlying losses, but then that just turned into a financial conflagration and a recession from which we have not recovered in many measures. Our GDP went down relative to trend, and we're finally growing a bit, but we haven't gained back the 10% we lost. Well, there's a big difference. The tech stocks were stocks. If you had invested your money in a tech stock or in an institution that bought tech stocks, and the tech stock loses a lot of money, what happens? The price of your investment goes down. You lose a lot on the statement, and what can you do about it? You can go home, drink a whiskey, kick the dog if you're really mean about it, but that's all you can do about it. Bemoan your sad fate that you didn't sell yesterday while someone is still in time. What happens when a bank gets into trouble? Well, banks borrow short terms. As Darrell showed us, on the eve of its failure, Lehman Brothers was invested in mortgage-backed securities. Now, mortgage-backed securities, even the worst ones, are very safe assets. They are far, far safer than some, whatever your friend who's doing a startup in Palo Alto has invested in. They're extremely safe assets. They're a diversified portfolio of loans. You can lose 5%, 2% maybe, but you're not going to, it's not this big, horrible, risky thing. Why was that the source of risk? Well, Lehman Brothers was financing its portfolio of mortgage-backed securities 30-to-1 leverage with overnight debt. Every morning, for every $1 of their investors' money put in, they had to find $29 of new money to pay off the people they borrowed $29 from last night. It's literally like running your house with gasoline in the basement. I mean, no wonder one morning those borrowers said, we're done. And then they couldn't pay off at 10 o'clock in the morning. They couldn't find new guys to pay off the old guys, and they went under. So there was a run. It was a run, not in the classic sense, Jimmy Stewart and the people coming to get their money, or little Michael Banks and so forth of a bank, but the mechanics were exactly the same. And if you want to find the mechanics, read Darrell's Failure Mechanics of Dealer Banks. In exquisite clarity will tell you exactly how the fancy dealer banks act just like what you saw in Jimmy Stewart. Now, what's the answer to that? The regulatory answer, after 10 years of strum and drang, I think we're finally figuring out the one central answer is not send in a bunch of regulators to make sure that the assets are even safer so that you can finance them 30-to-1 with overnight debt. The answer is risky investments need to be financed like the tech stocks were financed, with investors' money, where if it's a risky investment and it loses value, your statement goes down in price and you can't run and say, give me back my money now, and if you can't do it instantly, you're out of business. That's the mechanic that caused the crisis. So capital is the salve of all wounds, and I think we're figuring that out. So where are we now? Capital's a good deal higher. It's rough numbers from 5%, it's now 10%. In my view, 10% is nowhere near enough. 10% is good enough for a while, and capital is under attack because bankers don't like it. They like to goose up their returns. So looking forward, where are we? We have more capital in the banks, but the inevitable erosion, as the pain of the event fades, the inevitable erosion is underway. I hope it doesn't go too far. Where will the next crisis come from, I think, is something we need to talk about. I don't know. I'm nowhere near as good at Neil as at reading the tea leaves of history. But I'll tell you my own worries when I get up at 2 o'clock in the morning. Where are you looking for a crisis? Where is there a lot of debt, not equity, loans that can't be paid back, really shady accounting, off-balance sheet credit guarantees? Somebody is going to, go ahead and borrow and I'll pick up the deal for you. And a lot of short-term debt being rolled over and over. And where is nobody asking any questions? I would say that describes sovereign debt. We all, partly as a result of the crisis, we're now, the developed world's at 100% debt to GDP ratios. State governments have pensions that they have no idea how they're going to pay off. The US government has no idea how they're going to pay off its debts. Europe is also, China strikes me as a place where there's all sorts of debts, phony accounting, and who knows what's going to happen if they run into a serious downturn. And once again, the banks are stuffed with it. To this day, European regulators cannot bring themselves to say that Italian and Greek bonds might be dangerous assets for banks to hold. So the banks are stuffed with the sovereign bonds. If the sovereign bonds go under, the banks go under as well. So that's what keeps me up at 2 o'clock in the morning. More capital would solve that problem as well. So that at least gives you something to worry about. So from there, maybe we should go on to questions.
Yeah, thank you all. I think we could welcome some questions. There's people with mics that are coming around. I see right in the middle in the back there, a hand being raised. And raise your hand if you have another one.
All right. So the ascent of money was pretty solid, so thanks for that. I was slogging through Adam Tooze's new book called Crashed. He's at Columbia now, I guess. And I just started college during the 2008 crash, so it's a little bit of a personal obsession. I'm always wondering about what's going on, and he crafts this story that there was sort of like this behind closed doors, the Federal Reserve innovated to become the global lender of last resort in a way that most people still don't really understand. And I'm still trying to wrap my head around that. Was that a grand strategic masterstroke or a nefarious thing, or like what's the deal with that, and how should we think about that?
Yeah. Well, first let me say that Adam Tooze's book is an admirable attempt to write a history of the financial crisis, but it's quite early days to do that. And he relies quite heavily, if you look at the footnotes, on what I'll call the New York Times, Financial Times version of events. So there are some parts of his argument that I have big issues with, particularly his treatment of the European crisis, where he takes the kind of poor Greeks approach wicked Germans. But on the issue of the Fed swap lines, I think he's right, and he's not the first person to make this point. In the very early phase of the crisis, international cooperation was extremely important because the contagion spread fantastically quickly from the United States. It was a crisis made in America, but already by the end of 2008, it was clear that its impact would actually be greater in other countries. The impact on output in a whole slew of economies in Asia and Central Europe was much greater than it was. And later on, as Tooze shows, the impact in Southern Europe would be much greater than anything experienced in the United States. The fact that the Fed was able to provide dollar liquidity, money to the other major central banks, and indeed some of the minor ones, I think was quite important in preventing the 1929 to 31 scenario, because part of what happened then was not only did loads of banks fail in the United States, but they started to fail everywhere in the world, not least in 1931 in Europe. So it is an important point. It's not nefarious. The reason that it was somewhat, shall we say, low-key and not widely publicized was, I think with good reason, the Fed feared that there would be congressmen complaining that the Fed was playing this international lender of last resort role. So it got very little coverage at the time, but the scale of the operation was large, and I think it was extremely important in preventing the crisis intensifying even more than it did. Others may disagree.
I remember watching the vice chairman of the Fed, Don Cohn, testifying in Congress and getting raked over the coals over these central bank swap lines, with congressmen interrogating him very aggressively about why the Fed would ever be lending dollars to a foreign country when the United States was in difficulty. I completely agree with the point that you made, that it was very important to provide that liquidity. And I just broaden the point a bit to the distinction between bailout, which was the nationalization of banks or the provision of government capital to increase the capitalization of banks when they might fail, on the one hand, versus the proper role of the central bank, which is not to provide capital, but to provide liquidity, something that Neil emphasized. So that when a bank couldn't sell assets at a fair price in order to rebalance itself, the Fed would take those assets as collateral and lend the bank money, which is a different thing than a bailout. Now, during the depths of the financial crisis, there was a gray area, and the Fed had to go right to the limits, perhaps even beyond in a few places, of that gray area between liquidity support and bailout. But I would say that it was very important for the Fed to provide liberal amounts of liquidity to the US and foreign banking system with dollars at a time such as the failure of Lehman, just as it failed to do after the 1929 crash, causing an enormous depression.
I would just said, so these swap lines were to foreign governments, which is in some sense safer than foreign banks, because you kind of know they're good for it. And you can debate whether they should have a lender of last resort function of the Federal Reserve. But if you're going to do it don't debate that during the crisis. That's like saying we can either have a firehouse or we can all have fire extinguishers in our houses. But if we've told you there's a firehouse, then when the fire comes, you better call the fire department. Don't say, well, where's your fire extinguisher?
Other questions, comments? Right here.
Hi, so I also grew up in the financial crisis, and definitely impacts how I think about the economy. And my question goes towards sort of the institutional incentives and how those underlie the financial crisis, specifically around ratings agencies and also institutions regarding investigating fraud, which was, a big part of a lot of the settlements afterwards. How do we look at changing that to make sure the incentives are lined up correctly so these types of risky behavior that sometimes have been, verges on fraud don't happen again?
I could try rating agencies because I was on the board of Moody's, which is one of the world's largest rating agencies, from the month after Lehman failed until earlier this year. And you're right, there's an incentive problem because as most of the people here know, when someone wants to borrow money and they ask the rating agency to give them a grade, just like those of us up here on the stage do for the students in the audience, they get paid by the same person they're grading, and that is a conflict of interest. And the rating agencies, it's actually not easy to tell whether that conflict was responsible for the bad ratings that they gave to those mortgage-backed securities that failed. If you look at the ratings they gave to corporations before the crisis, they performed exactly as one would expect. And they definitely got it wrong in the housing market and can be blamed for not understanding the big risks in the housing market. I'm not sure that they succumbed to that conflict of interest, but as I just mentioned, at least up until recently, I was myself conflicted on that. After the crisis, Congress tried to find another way so that the rating agencies wouldn't have to get paid by exactly the people that they were rating. And they tried many options, and none of them would work. In Europe, the option that was tried was we're going to have a government rating agency, and we're going to have the government rate everything. And that obviously presents a conflict when the European government as a whole is going to be rating the Italian government bonds, for example. So far, no one has found, even despite how bad the conflict of interest is, no one has found yet a better model and brought it forward.
Let me suggest one. This is a problem of regulation. So if banks were funded by issuing equity or other floating value claims, if there wasn't this debt and regulation issue, then there wouldn't be a problem. The problem is the banks want to take risk because as Darrell said, they're taking risk with government guaranteed funds. The people that they're investing in want to issue risky securities. So they want to get together and make this risky bet. But the government's saying, oh, no, you have to have AAA securities. Well, the obvious thing, okay, the government says we need AAA. I want to buy something risky. You want to sell me something risky. We have to make it look AAA so the government gives the stamp of approval. You can see what's going to happen here. If the incentives are aligned where it's just where the rating is just like a Yelp star or a Consumers Report thing, and not to help you satisfy some regulatory requirement that is annoying to both parties, then the problem won't be there.
Can I add one thing? A very bad explanation of the financial crisis, which has become quite popular. I would say that the popular narratives about the crisis as they currently appear in, let's say, the broadsheet newspapers are generally wrong. And one of the popular ones is that the crisis came about because of deregulation and can somehow be traced all the way back to the 1980s and 1990s. I think this is terrible financial history because the really striking feature of the crisis is that it emanated from the most regulated institutions. The problem was there was lots of regulation. It was super complicated regulation and it wasn't very effective. There were many agencies who were supposedly responsible for the banks and the mortgage market. And a recurrent theme of, I think, our conversations has been that excessively complex regulation is actually the disease of which it pretends to be the cure. And one of the big problems with the post-crisis response has been, if the crisis was the result of deregulation, let's have lots of regulation. And hugely complex statutes, not least Dodd-Frank, resulted. The Basel Accords on bank regulation are vastly longer and more detailed than they were in their first iteration. And this, I think, is a really good example of how learning the wrong lessons from the crisis could, in fact, lay the foundations for the next crisis.
Questions? Right here?
Hi. Just wondering how much of the root cause of the crisis is just that when something hasn't happened in the last 50, 75 years, people start to assume that it won't happen and then lend against it. So, whether it be real estate or sovereign debt or stocks, when there's lending against something because it hasn't had a massive crash in the last 50, 75 years, does that then become a root cause for regulators to make certain assumptions and the two parties who are trying to get together and do risky things to make some assumptions?
So there's a view that stability breeds complacency, and this Minsky's written a lot about that. What's curious to me, I don't think that was as much of an issue as some people think, but the people who write most about the complacency created instability are the central bankers. It's very interesting to me to read what people are writing about this crisis after the fact, and the history is changing. It's already been 10 years. But many of the people who are writing about what happened are the people in charge. And I gave an example about my view about instability actually caused to some extent by the central banks. The former governor of the Bank of England, the former governor of the Bank of Canada, who's now governor of Bank of England, both wrote pieces exactly opposite that said, no, it occurred because of all this complacency out there. I just think there's very little evidence for that, but it's part of the debate. It's going on. So,
well, part of the complacency came from the feeling that home ownership is a good thing. And so you wound up with home ownership with people who had debt that was underwater. Suppose you had gone about handling the crisis by the president, say, explaining what happened and saying, we still think home ownership is a good thing, and we're going to bail out, not banks, and so we're going to bail out the people who own the homes so they don't get foreclosed on and they can hold their own homes. That would have done a good job.
Can I add something on the subject of an area where I do think there was real complacency? I think in the housing market or the mortgage market. If you look at the ratio of home values to rents going into the financial crisis and the Great Recession, they were really only consistent with the idea that home prices would just keep going up forever and ever and ever. And so I do think there was complacency. I think people said, well, look, they've been going up for a long time, so why should they not go up again next year and the year after and so forth and so on? And that you had to sort of believe that to justify those house prices. And then as soon as house prices started to fall, of course, those expectations couldn't be maintained. And house prices, since those expectations had been built into house prices, it was a cycle that was hard to break. And because people had had the expectation that their house prices would keep going up, people were willing to lend to subprime borrowers who put very, very little down. Because it really doesn't matter if your house price is going to keep going up and up and up, you'll end up with home equity, even if you start off with almost no equity, right? But once your house price falls, you're underwater right away. So I think in the housing market or the house lending market, there was a lot of complacency, or at least the belief that what has gone up for the past 20 years will just keep going up.
It's also worth adding that this is why financial history is really, really important, because most people in the markets were just basing their observations on their own lived experience. The people running the investment banks had, on balance, got into finance in around 1982. They had absolutely no personal experience of anything resembling 1929, and practically nobody did. The only way you really knew what was going on was if you'd actually studied the Great Depression. And I used to routinely ask audiences this size of financial professionals, how many people here have read Milton Friedman and Anna Schwartz's Monetary History of the United States? And it would be 2 on average. And these were the people running the financial institutions.
But let us take the lesson.
Question right up here. One more question in the front.
Can I
I'm
be
sorry.
sure?
Okay.
Suppose it is complacency. Then what do we do about that going forward? And our regulators are telling us, we've learned our lesson. We're going to be tough. we're going to take that 5 times bigger rule book and every I and T is going to be crossed. Well, if it was complacency last time, you can count on complacency next time. So that sounds like a very bad way to do things going forward. That's why changing the system so it isn't so fragile seems like a much better and more durable approach to it than just counting on we won't be complacent next time, because they're still not reading their history, Neil.
So right behind you, Christine, yeah.
I'm just curious, do you see any relationship or similarity between the Fed pressuring the lenders to lend to people that weren't qualified really to get into a house, and and then having them fail, and the current issue with student loans and those perhaps not being paid back either? Do you find that that is a similar situation? And anyway, I'd just like to hear your answer on that. Thank you.
Maybe I could
Yeah, you take
address
that,
this
yeah.
because I work on student loans. Yes, there's a lot of similarity. In fact, if you think that the U.S. government was encouraging poor lending in the mortgage market, you ought to be a lot more worried about student loans, because in the home lending market there was some amount of underwriting. In other words, when you went out to borrow, the lender did look at your credit score and did look at what home you were borrowing, and there was an appraisal, and the loan that you were given was a function to some extent of your income and expectations about your future income and so on. With student loans, there is no underwriting whatsoever. A student can be the best qualified student in the United States who very clearly is going to get a wonderful college education and will be easily able to pay back his or her student loan. And that student will get exactly the same loan terms as a student who was failing all of his classes in high school and barely managed to get a high school degree or a GED. So there's no difference in the loan terms given to those two types of students. One type of student is predictably not going to be able to pay back the loan. The other type of student is going to be able to pay back the loan. We, in fact, are very good at predicting whether a student can pay back a loan just by looking at what they're like going into college, and they get exactly the same loans. The student loan crisis is entirely concentrated on a certain set of students who we can predict have a high probability of not being able to pay back, and we, more or less, no one would lend to them if the federal government weren't insisting that they be lent to. So it's a very, very concentrated problem. Essentially, students at institutions like this always pay back their student loans. There are other institutions where almost no one pays back their student loans. And so it is if the mortgage market were as messed up as the student loan market, it would have been even worse. Let me put it that way.
So we have to stop here, but you're welcome to join us in the next room for some pizza and more questions and more discussion. So thank you so much for coming.